Am I the only one that thinks that this world is full of acronyms and it's hard to keep track of what's what? I mean, we have OPP, BFF, WTF, LTV, and what we're going to cover today, which is PMI. PMI is an acronym that stands for Private Mortgage Insurance, or casually known as simply mortgage insurance. I'm Mark Lima, your favorite real estate broker with the Lima Real Estate Group, and I'm here with my preferred lender, Justin, over at Arbor Financial Group, and we're going to let you know just what PMI, Private Mortgage Insurance, is. So go ahead, Justin.
Absolutely. So PMI, as Mark said, Private Mortgage Insurance. This is put in place. Let's say you're doing a conventional loan and you're putting less than 20% down. So when you have less than 20% down, you do have to have PMI or the mortgage insurance. And simply what it is, it's an amount that's tacked or added to your mortgage payment. The mortgage insurance is going to run anywhere from $100 to about $200 a month, and the amount is based on your credit score. And mortgage insurance is not issued by the actual lender, the bank. There are a few third-party vendors that all banks and lenders use across the country. And so these third-party companies are the ones that actually issue the mortgage insurance. One little tip for everyone out there, something that's gaining a lot of popularity right now is doing what's called a first-second mortgage combination to avoid paying the mortgage insurance. So a quick example would be you take the price of your house, 80% of the price of the house, that would be your first mortgage. 10% of the price of the house would be your second mortgage, and then you would come out of pocket with 10% down payment. So it's also called an 80-10-10 loan, and that is a current way that's, again, gaining popularity to avoid paying that mortgage insurance.
One question on that. If someone was to maybe be at like 17% down payment and thus had some mortgage insurance, when they cross a certain threshold of having 20% equity, does that PMI or private mortgage insurance drop off, or how is that handled?
It does, and that's a great question, Mark. So it does get removed, or as we call it in the lending word, eliminated. But there's two things that have to occur for that to happen. Is the homeowner has to keep the loan at least 2 years. So 2 years have to pass, and you have to have that 20% equity in the house. So in a normal market, usually what we do is most people that are that close to having 20% equity, maybe within the first year, they're going to refinance out of their loan into a new loan to get rid of PMI. The only issue there is with interest rates steadily increasing, doing that second transaction or refi may not be the best move. But yes, in general, after 2 years, you can get that removed without having to do a loan, having to touch your rate, or pay any kind of closing costs. Great question.
So how is that determined? Is an appraisal done or something, or?
It's an AVM. So basically it's like an automated or online appraisal. The homeowner pays a $150 fee for that automated valuation. And that's how the lender determines that they do in fact have 20% equity in the home.
Awesome. Great. Well, I hope you guys walk away knowing what's going on in the mortgage world this week. And also, hopefully with a little bit of a better understanding of what private mortgage insurance or PMI is, and ways to get out of it, or what the implications may be for you. I'm sorry. So without more to say, I think we'll just leave it there, and we'll catch up with you next week, next Thursday, for another episode of the Mortgage Minute, where we do kind of much of the same. Have a wonderful day.